Hello everyone, welcome back to my channel Finance with Maksud Rahman. I hope everyone is very well and healthy and happy. So today I'm going to describe the weighted average cost of capital, which is one of the measurement the investor used to get the expected rate of return. And today I'm going to explain how does it work, and not only that, I'm also going to explain how to calculate the weighted average cost of capital in a practical manner. So let's not wait and move down to the topic. So what is weighted average cost of capital? It is company's average tax of after tax cost of capital, and WACC is a common way which determined the required rate of return. So you can see the RRR. Sorry, oops. Let's go back for a bit. The RRR, and which is a single number, and the return that bondholder and shareholder demand in return for providing the company with the capital. So that means this is the return a company investor expect from the company who invested in the company, equity or bond. So a company's WACC is likely to be higher if the stock relatively volatile or the debt is considered risky, because investor will want greater return to compensate them for the level of risk. Obviously, if a company's stock is very risky, and in return the investor will demand a higher rate, and same will be applied for the bondholder as well, because obviously they are going to loan the money to a company. If it is risky, they will obviously demand a greater return of their bond. So WACC will calculate the return expected, which include the bond and the capital, sorry, and the equity, which um, in total is the capital. So WACC calculation is quite simple formula. So WACC, here you can see the return of the bond and the weight of the bond. So here, so you can see RE is the cost of the equity, RE cost of the equity, and if you see the EV is the weight of the weight of the equity. And you can see also here that here is the bond return and the weight of the bond. So dB is the weight of the bond and the RD is the return of the bond. And we all know bond doesn't include the tax, so it's after tax cost, because we exclude the tax after we pay to the bondholder. So it is a tax-free money for the company. So that's why we deduct the tax TC from here. So if we follow this formula, then we will get the weighted average cost of capital. But the thing is, how would you get this number, the weight of the equity and the expected return of the equity and the expected return of the bond, weight of the bond, and tax rate is 30%, that we all know. We only got the tax rate here, so we need to calculate all the other number. But to calculate the cost of capital, we need to move to the other slide, actually the cost of equity. So here you go, the cost of the equity. The cost of the equity is the risk-free rate plus the beta, and the it would be multiplied by the sum product of market return minus the risk-free rate of return. So we need to get this number through our Excel calculation, and especially the beta. So here is the most crucial part. calculation of the beta. So the 70% of the project that I'm going to do is based on beta. So before we calculate the beta, we need to know what is levered beta and what is unlevered beta. Levered beta measures the risk of a firm with debt and equity in its capital structure to the volatility of the market. A key determinant of beta is leverage, which measures the level of company's debt to its equity. So levered beta actually consider the market risk and the debt as well. So but if we unlevered the beta, which is take the leverage out from the beta, which measures the market risk of the company without the impact of the debt. Unlevering a beta removes the financial effect of debt. See what I said, it removes the financial effect of the debt, so it takes out the risk of the debt, which will isolate only the equity. So levered beta, unlevered beta represent the risk measurement or the exposure to the risk of only on the equity on itself. So this is it. So I let's not wait and move down to our Excel file and do the calculation. So to do the weighted average cost of capital, we need to get the beta to get the cost of the equity, and to get the beta we need the prices of the companies that we are going to analyze. So here we have four companies actually. Apple, here we got the prices historical of 1 year of Apple, and also we got the price of S&P 500 as well to make our comparison. And here you can see the prices of Apple. So we have downloaded the daily prices, and here is the price of AMD. So you can see I have downloaded the daily prices, and to run my regression to get my beta, I have also attached the S&P 500 data as well. So here is the data of S&P 500, and here so on this table we are going to make our analysis to get our WACC. So we need to get the return from the Apple, so simply divided by current return by the previous return, and then here we got the return of the yearly total year on a daily basis, and now S&P 500 will do the same. So this is the table for the Apple, -1. So just double click it, and then we got the prices for the we got the return for the S&P 500 here. So you can see the return daily basis, and we are going to do the same thing for all the cells, all the sheets. Now we are going to do the AMD one. So previous year, current day price minus the previous one, -1. It will give you the daily basis return. Double click it, that's it. And now same thing we will do for S&P 500 as well. Double click, that's it. So it gives you the result to the end. Now for the Sony company, so all of these four company are quite similar. If I say like Apple technology, they produces, AMD both technology, and if I talk about Sony, we all know Sony produces technology, and Microsoft computer, Microsoft phone, Windows phone, so they all are similar quite. So here is the Microsoft one, current one divided by previous one, -1. Double click, Yeah, that's it. And for the S&P 500 we're going to do the same as well. -1. Here we go, double click. So we got the price, return. Okay, let's do the S&P 500 as well. -1. Here you go. So to get the beta we need to run the regression to get our beta. So we can do it quite easily by simply taking the, so we put it as leverage beta because it includes the debt. So, and I'm going to do the unleveraged beta, unlevered beta on my table, the final sheet, where I am going to do the WACC, weighted average cost of capital. So we have to run the regression now here for the Apple. Select the cell. The y-axis is the independent variable, the x is the x is the dependent variable, so which is S&P 500 and y is the independent. So here you go, the beta we have got, levered beta. It is negatively correlated. Okay, so for the AMD we are going to calculate the beta now. Put it as levered beta. So simply it would be data analysis tool pack, regression, select the y-axis and the x-axis. Y is the independent, y is the dependent, and x is the independent. So here we got the beta about, which is 2.33 something. Now for the Sony company, levered beta, same we are going to run the regression. Regression is something which will give you the slope, how the market like react. So beta actually define how it like interact with the dependent variable interact with the independent one and give you a slope. Like here is 0.92 for the levered beta of Sony. Now finally the Microsoft. Regression. Okay, simply select the data. Excel is automatically taking the data as I have already put on in the first sheet, so it's automatically taking, which is quite good and interesting as well. So 1.1 something for the Microsoft. Adjust the cell and then press it. Here you go. Just remove the decimal point, clear the cell border. That's it. So we are quite done. So to verify our beta is quite right, beta and slope are quite same, so we are going to get the slope as well, because when we run linear regression we get a slope, so which is kind of like beta. So actually to verify our beta is right, so we are going to do a slope analysis for this. So simply you will write slope, and you will select the y, the dependent variables, the return for the Microsoft company here, and the return x variable, which is the return for the S&P 500 Standard and Poor. So we can see here, if we remove the decimal, 1.1 to 1.12, so we are absolutely right, we are on the right track. Slope beta. So now we are going to input the point, whatever the beta result, to our WACC table to calculate our result. There you go. So I made a table here. You can see the Apple. I have input the debt. I've taken this debt and equity from their balance sheet of 2023. So Microsoft, Sony, AMD, Apple, I have got the data, and tax rate is 30% for the US companies. So I all of them are US stock listed companies, so they have the same tax rate. So let me show you how I have gathered the data. So simply write Apple. Here you go. As I told you before in my previous video that this is US government website where you can download your data from here. So you will get the data from 2023, 12 and 30. So end of 2023, the annual data. I need the annual one, because which will give me the sum of result of the end of the year 2023, not the quarterly one. So press interactive data, and then simply go to the financial statement and the where is the balance sheet or financial statement here, and then the consolidated balance sheet. So here you can see 290 here, the liabilities, so 290 here. So I actually got this data from the individual company's balance sheet from that website, and just put it on my Excel sheet to do my analysis. There you go. So now I'm going to do some ratio analysis, like quite a bit of. So simply so debt divided by equity, simply debt. So I will just double click it to get my result. So I'll cut the bottom two cell because it's not included in the table. Debt divided, debt to capital should be debt divided by the debt plus the equity, total capital. So simply it would be and just double click it. That's it, we got our result here. So now we are going to take the data of the individual sheet, Apple, Unlevered, Levered beta. So sorry. Sorry, I need to copy it again. Then simply paste it. For the AMD, we're going to go to the AMD sheet and just copy the cell, and then paste it. And we are going to do the same thing for the levered beta for everything. So the reason we are going to get the unlevered beta is that we are going to exclude the beta exposure from the debt from our beta. So we are going to cut the effect of beta of the debt from our beta and get the beta which is based on the equity, which is the unlevered beta. So our plan is we are going to get the beta of the 4 companies, the unlevered one, and then we are going to get the median. So here we are going to do the average one for this debt to equity and debt to capital as well. The reason we are taking this one because it would be our target, because this is the average of these 4 companies, so which we will consider as the target debt for the company. Whichever company we will take, AMD, Apple, Sony, anything, this would be our target debt to equity ratio, debt to capital, and then median for this. Here you go. Now it's time to get the unlevered beta. So we will get our unlevered beta from using the formula. Simply it should be the levered beta divided by the 1. You will get the formula on Google. Is it how to transfer a levered beta to unlevered beta? It should be 1 plus 1 minus the tax rate, and it will multiply by the debt to equity ratio. So it will exclude the effect of debt actually using this formula, and we are going to take the median of this 4 company. So double click it to get the 4 companies. So the reason we are get the median, which is why, because it would be a perfect beta, because we are taking the average and we are going to assume that whatever the 4 companies going, that way the company is going to react. So in the future, in long term, so this is why we are going to take the unlevered beta median, and then we are going to again transfer it back to the levered one, because we can't analyze based on something which is unlevered. We need to adjust the debt as well, so we are going to transfer back to the levered one. So total debt here is 11,993 equity. We are going to do the AMD one. So if we sum this to 1, 67,885. The current is simply divided by the total capital, 18%, and now we are going to take the industry average, which we got from the 4 companies. So it would be 56%, and then we're going to 1 minus then this percentage, it would be our target equity, which we have got from the average of this 4 company. So we are assuming that in long term, whatever the company's average, the company is going to get on that way, if it follows the company. Obviously the company is going to follow the industry. So this is it, 100%. So now we need the risk free rate. So simply the risk free rate is 4.306%. so we need the risk free rate to calculate our cost of capital. So risk free rate, cost of equity, to calculate our cost of equity. So we know the formula. It is risk free rate and plus the additional risk premium multiplied by the beta, which we will be getting. So industry median beta, we need to get the beta, the levered beta. We got the industry median beta, unlevered one, so we need to transfer it back to the median, this median beta to the levered one, to adjust the debt that we have. So target debt to equity percentage and tax rate would be 30% here. Take any one of these. Oh, sorry, need to put the equal sign. So here you go. Now we need the levered beta. So this, the previous beta of AMD, we can see is 2.34, which only represent AMD, which doesn't include the market risk. So by making the levered beta unlevered and taking the median and put it back as levered one, actually adjust the market exposure to the company. So the formula is simply the industry median beta multiply 1 plus 1 minus the debt to equity, and it would be multiplied by the tax. Here you go. So you can see it is now 3.22, 2.85 to 3.22, as we have considered the result of the debt. So the beta is obviously going to increase. So this is the actual beta, and this is how the market analyst work to get that beta, and I think this is the proper way to doing the beta. So we need to get the equity risk premium. So to get the equity risk premium, we got the levered beta, risk free rate, and we need the return of the equity. So simply risk free rate plus we need the return of the market. So to get the return of the market, we can simply take the return of the S&P 500, because this represents the return of the market. So simply write S&P 500 return. So take the return till today. So take average. So here you can see 10.3% and over 10% on an average here. investor confidence in investing in, okay, 10.28% here, this one here. So we can take 10% as the return of the market, and we'll simply deduct the risk-free rate of US Treasury to get our return, excess return of the market on top of the risk-free rate, and then we'll simply multiply with the beta, the levered one of the median, to get the actual return, expected return. Oh sorry, I think I did one mistake. It is not supposed to be 4.3%. okay, let me check it again. Oh, I think so. Risk-free rate plus, I have to input the number 10%, I guess. Yeah, 10% of the return of the S&P 500 minus 110 minus the risk-free rate multiply by the beta. Oh, now it's fine now. 22.70% or 23% we can say for the return of the equity that we want. Now cost of debt, simply the interest. So we are doing on AMD, so we need to get the data for the AMD, not the Apple, sorry, my bad. So AMD, right on the same website, and 10K file, annual reporting, and again view all the filing here, interactive data, and then consolidate it. We need to get the interest income from here, which is 106, and we need to divide it simply by the long-term debt. Long-term debt is 1717 million, so 1717 million for the AMD company. So simply cost of debt would be 106 divided by this percent. Oh, why it's not coming? Oh, I forgot to put the equal sign here. So this is our cost of debt, which is around like 6%, and now we need to adjust the tax rate. Pre-tax interest rate is tax is 30% here, so the cost of debt would be 6%, around 4%. I think I label it wrong, so this will go there. Pre-tax is 6% and cost of debt would be 4%, which has taken account the tax rate and get the less amount of cost of debt, because we have multiplied with 70%, which we got after deducting the tax of 30%, so which make total of 100%. So cost of debt is 4%, cost of equity is 22.7%, and we got the weight is 56%, the target weight, and the equity is 44%. So we got everything to get our WCC, weighted average cost of capital. Oh, I think I'll mislabel something. So cost of equity should be 22.7%. Let me make it right, and just make it bold, and we need the risk premium. I labeled it wrong. Let me make it right. So cost of equity, weight of equity is simply 44%, and cost of debt is 4%. Mm-hmm. 4%, and weight of debt is 56%. Yeah. Now the simply formula is cost of equity multiplied by the cost return of the equity, and plus the cost of debt multiplied by the weight of debt, which will give us the weighted average cost of capital. Multiply by the weight of debt. So we can see here it's 12.4% around. If we reduce the decimal point, 12.4% for the WACC of the AMD company, which is quite good. It's not quite too much, but it's a bit more than S&P 500. Obviously, when you're going to invest in one company, you can expect more return. As S&P 500 giving us 10%, we can expect from the AMD 12%, because that one is portfolio, and this is a single company. Single company has more risk, so more return. So I think this is it, and I'm going to show you is the company return is same to the analyst one. So you can understand how good is our analysis that we have done so far for the weighted average cost of capital. So we done here Unlevered beta, and then we got our cost of equity, we got our cost of equity 22.7%. Okay, I missed one thing, which is risk premium. Risk premium on top of the risk-free rate, which is 10% for the S&P 500. Wait a second, I missed one point. It's not on the calculation purpose, it's just to show you, because I have already done the calculation. So S&P 500 return, which is 10%, and the risk premium is simply 10 minus the S&P 500 return minus the risk free rate, 6%. Now make the border to make it much more beautiful. Here you go. We need to correct our formula, which will give us the same result, because in my previous formula I put just 10% straight away, hard coded it rather than putting the formula, which is quite simple. So let's find out the return WACC from the actual investor analyst who done for the company, the specialist. So WACC of AMD here. So it's 12.17%, which is quite same. Our is 12.04%, which is quite same. So if you use this model, and if you get the Apple one, Sony one, and Microsoft one, I'm pretty much sure you are going to get the exact same amount of WACC for the other companies as well. If you take the industry average by using the median beta unlevered one and then turn it back to the levered one, so it should be fine. Here you go, we finish here.